Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. Your weekly fix of local and international news for investors and traders alike. These are the stories that really caught my eye in the past week. Welcome to this post-election edition of Supernatural Stocks, and what a week of headlines it has been. But I'm going to focus on one of South Africa's best-known retailers to just remind you that a bottom-up analysis of the markets is just as important as understanding the political context. Now, the Australian misery that entered our lives as South Africans when Alan Donald dropped the bat in the 1999 Cricket World Cup semi-final, well, you might have thought it's gone, and you might be forgiven for thinking that based on the disposal of David Jones by Woolworths and all the excitement around hanging on to Country Road. But unfortunately, you would be mistaken. That unforgiving landscape has inspired many daredevil wildlife enthusiasts and has hurt plenty of South African corporates, with the pain in that region seemingly not over for Woolworths. This is part of a much bigger challenge at Woolworths that I'm going to dig into on this podcast. Before we get into the details, I must point out that Roy Bagattini was appointed as the CEO of Woolworths in February 2020, a time in the world that was even more unforgiving than the Aussie outback and those jokes about how there would be even more snakes, if not for the spiders that eat them. He walked into a difficult turnaround and then an almost impossible backdrop for retail, as the world went crazy and roast chickens were banned by government. Remember that one. It's hard to properly gauge his performance by only using the share price because there was just so much noise around the time that he joined, and thus picking the correct start date for the share price really is difficult. Instead, we have to consider other approaches, like the importance of getting David Jones out of the system, leaving Country Road as the primary operation in Australia. But then we also have to consider recent operational missteps and the resultant punishment in the share price, issues that really are starting to cloud this turnaround story. But back to Australia. Country Road is an important contributor to Woolworths. In the 2023 financial year, it contributed slightly more profit before tax than Fashion, Beauty and Home, or FBH, both coming in at just over 1.6 billion rand. For context, Woolworths Food was good for 2.7 billion rand. With David Jones as a well-documented catastrophe that will forever be associated with Ian Moyer's time running the company, Bagattini would have been forgiven for thinking that Country Road was worth hanging on to as part of the recovery plan that would of course see the disposal of David Jones. But the wheels came off in the first half of this financial year there, with profit at Country Road dropping from 991 million rand in the comparable period to just 483 million rand. Now, along with various operational problems in the FBH business in South Africa, the interim period caused much concern for those who were believing strongly in the turnaround, setting a dangerous stage for the release of full-year numbers. If you combine FBH and Country Road in the interim period, then profit before tax for those businesses was down 33%. Woolworths Food was up 11.7%, helping to avoid a complete catastrophe. Group adjusted profit before tax was down 12.1% for continuing operations and 31.8% across total operations, but that latter number includes the distortions of David Jones in the base period, so it's not really worth focusing on. The market was hoping that some of the issues faced in the interim period would subside, leading to better full-year results. But sadly, a trading statement for the 53 weeks ending 30 June 2024 has made it seem like things have gotten worse. It tells us that earnings are down more than 20%, but the thing to remember is that this is the minimum required disclosure for a trading statement. In other words, they already know with reasonable certainty that it will be a drop of more than 20%. So it's very possible that it will be far worse, especially when adjusted diluted headline earnings per share was already down 26.3% for the interim period. And there was no shortage of narrative in the trading statement about how the second half hasn't been as good as they hoped. The David Jones distortion remains an irritation here, unfortunately, because the trading statement doesn't give a view on earnings from continuing operations. We really cannot be sure where the earnings from continuing operations will end up, but the interim period was down 5.6% on adjusted diluted HEPS from continuing operations, and the trading statement has a bearish tone about the second half of the year, so I don't think it's going to look any better than that. If we look back to the interim period, Country Road was suffering with the weaker Australian dollar and how that affects import costs, as well as pressure on discretionary spending and the impact this had on promotions and thus gross margin. They highlighted negative operational leverage, which means that margins fell. In the trading statement for the full year, we find much of the same language for the group and especially for Country Road. This tells us that the Aussie headaches are far from over at Woolworths. It was not as easy as selling David Jones and letting Country Road fly. And problematically, FBH in South Africa also sounds like it's struggling, with negative operating leverage. The only highlight really in these numbers is Woolworths noting that the food business has shown resilience at a time when the group is facing lower footfall and discretionary spending in South Africa. FBH was down 10.4% in the interim period in terms of profitability, with it being quite possible that the full year result looks worse. Woolworths is back to relying on the food business to deliver growth right now, which is a dangerous place to be when your biggest competitor is the behemoth that is Checkers. Yes, Woolworths will of course feed off the carcass of Pick n Pay, and I'm sure that's what's happening this year, but that only gets them so far. Shoprite Group loves the higher income consumers and the margins they bring, with what seems like an unassailable lead in 60/60 and excellent customer resonance in their Fresh X stores that have converted many a Woolworths food shopper. This is why the market loved the previous momentum in FBH, an area of traditional strength for Woolworths and a back-to-basics kind of strategy, where they are not competing with Checkers, but rather with a more fragmented market without a clear monster in it. So, back to that Woolworths share price. With the excitement of the FBH business improving dramatically under Bagatini until FY23, the share price made it all the way to over 81 Rand at one point. It's now trading below 55 Rand, and momentum is very weak, with the share price only slightly above the 52-week low. If it drops below the current support level, which goes all the way back to mid-2022, it is a long way down to the pandemic lows of around 28 Rand per share. I'm not saying that will happen, but be aware of the risks here. And as a final comment on Woolworths, the full year result is for the 53 weeks to 30 June. This is one of those retail trading calendars with a whole extra week of trading. And of course, that extra week of trading is in the second half of the financial year. So you would expect to see a nice uptick in earnings in the second half of the year because of an extra week of trading. And yet there is still this narrative of pressure on earnings and a disappointing second half. Yikes. For all the troubles we've now covered at Woolworths, I'll finish off with Pepkor. This is a great example of a company that has chosen a particular strategy and is executing on it, with revenue up 9.5% for the 6 months to March and gross profit margin improving by 200 basis points to 38.1%. The margin improvement along with revenue growth is impressive, driven by various factors ranging from cheaper shipping costs through to continued improvement at Ackermans. But the real story here comes from the trend in credit sales, which increased by a whopping 34% versus cash sales that were only up by 3.8%. Investors in more cash-based clothing retailers would do well to take note of that trend. Pepkor is pushing credit sales hard in what they call a credit interoperability strategy, quite the tongue twister there, which reduces friction in the process for buyers. They've effectively invested 3.1 billion Rand in credit books, so those buyers are there and the strategy is working. Of course, this does add on another layer of risk to Pepkor that makes it look more like a bank and less like a retailer, so keep that in mind as well. Headline earnings per share is up 7.8% on a normalized basis, which is encouraging, but it comes at the expense of more risk in the business model. Speaking of the business model, I must mention that the fintech revenue is up 24.5%, driven by Flash and its network of 165,000 traders, as well as the number of written insurance policies in Abacus nearly doubling. With bits that look like a fintech company and other bits that look like a bank, Pepkor is about more than just selling clothes. That seems to be the way to succeed in a South African market where lower income consumers are struggling more and more by the day. Luckily, there is some exposure beyond just South Africa as well, with Pepkor posting strong revenue growth in both Africa and in South America through the Avenida acquisition, a deal that I've really liked from the start over in Brazil. The share prices in this sector have been strong over the past year, particularly at Truworths, with growth of 55% off a modest valuation. That's a value investor favourite in the sector. Mr. Price is up 39%, the Foschini Group is up 12%, and Pepkor has managed over 15% share price growth. Those numbers did all look far better before the past week, with the elections and perhaps the update from Woolworths spooking the market. Those counters all lost between 4 and 8% in the last few days. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.